Hello and welcome back to part 3 of this Applied Management Accounting mock walkthrough. Within this part, I'll be taking you through tasks 5 and 6. What we'll do now is we'll swap over to the mock and make a start. So then, task 5 is worth 20 marks and this task is about decision making techniques. This task contains parts A to E. Part A, identify whether the following statements are true or false in relation to short-term and long-term decision making for 4 marks, so 1 mark for each statement. So we just need to have a look at each of these statements and determine whether they are true or false. So the first one, relevant costs are only considered in long-term decisions. Well, that one would be absolutely false. It can be used in both short-term and long-term decision making. So obviously for such as relevant costs, you could change product prices, you could have a look to see if you could source cheaper materials elsewhere. You could look at something to do with labour, whether you can make it cheaper or whether you need to change staff. So relevant costing, of course, can be used within short-term decision making. The next one, cash flows are less certain in long-term decisions. That would be absolutely true. So the further into the future that we go, obviously cash flows do vary. We've got to take into consideration interest, for example, which is why many businesses will use a discounted cash flow because it shows what the cash flows would be taking into account the cost of capital, so the costs of borrowing, for example. So the further that goes into the future, they would be less certain. So that would be true. The next one, significant capital investment is required in long-term decisions. That is true. So remember, for long-term decision making, you're looking at what project would be best, would be most profitable for the business. And often that comes with buying new non-current assets, which again requires a significant amount of upfront investment. So that would be true. The last one, there is no risk with short-term decisions. That's obviously false. So yes, obviously long-term decisions may have more risk because they require that bigger capital investment. However, short-term decisions can obviously have a huge impact as well. It could be that we source new materials to try and get them cheaper, but then they're low quality. And then obviously that affects the quality of your products. So to say there's no risk is simply false. There is less risk than within long-term decision making, but there is certainly not no risk. Okay, so that completes part A, nice and straightforward to start off with. Let's move down to part B. Complete the following statement about short-term decision making for 3 marks. When making short-term decisions, you should include, we've got a few options. So we've got past costs and revenues, future costs and revenues, sunk costs and revenues, and lastly, historic costs and revenues. So this would relate to future costs and revenues. Remember, when using any form of decision making, whether that be short term or long term, you are always looking into the future, and therefore it would be future costs and revenues. Obviously, there's nothing you can do about past costs and revenues, so when using decision making, it is always going to affect your future costs and revenue. So following on from this, let's read this back from the start so it makes sense. So when making short-term decisions, you should include future costs and revenues, which are, and then we've got non-specific, existing, incremental, and targeted. So any future decision making needs to be based upon incremental costs and revenues. So this is effectively where we sell one more unit or purchase one more unit. And the effect of that decision making would affect either the total cost or the total revenue. So it's effectively what happens if we were to sell or buy one more unit. How would our costs affect those future purchases of one or more units or sale of one or more units? And that part is your incremental. And then following on, and only incorporate, and we've got cash flows, notional costs, provisions, and non-cash items. Well, considering you don't include the bottom 3 within relevant costing, it would be cash flows. Okay, so that completes part B. Let's scroll down. F Limited currently buys in one of its biggest selling products, but is considering whether it would be cheaper to make the product itself. The cost of buying in the product from the external supplier is £12 per unit. F Limited would make and sell 21,000 units each year. F Limited has estimated the manufacturing costs detailed in the table. So we've got a little table here which shows the cost information for materials, labour, supervisors and factory rents. And then we've got some notes for each of them. So part C, identify whether each of the following costs are relevant or non-relevant to the decision. Okay, so the first one on there is material. So we can see that each unit requires 2 kilograms of material, and it states the main supplier would charge £2 per kilogram, but can only supply 20,000 kilograms, and the remaining material would cost £3 per kilogram. Okay, so obviously if they were to undertake this project of making the product in-house, they would have to pay for the material, and therefore, of course, it is a relevant cost to the decision making. The next one, direct labour. So each unit takes 15 minutes to produce and production workers are paid £12 per hour. So again, obviously this would be an additional cost to the business and therefore would be irrelevant. The supervisor. So one of the existing production supervisors would spend 10% of their time on the new product, and supervisors are paid £22,000 per annum. So this would not be an additional cost to the business of undertaking this project of producing these units in-house, because this supervisor already exists and it was already being paid. Therefore, it wouldn't be relevant for the decision making. And then the last one, factory rent. So extra factory space will be required, costing £31,500 per year. So obviously that would be relevant because it is an additional cost for if you were to undertake this project. Okay, so we've identified which of those costs were relevant and which were not. So moving on to part D, it states calculate the estimated total manufacturing cost. Show your answers to the nearest whole pound. And if your answer is 0, enter 0. So 4 marks, so 1 mark for each box. Okay, so first off, let's have a look at the material cost then. So materials, it states each unit requires 2 kilograms of material and the main supplier would charge £2 per kilogram but can only supply 20,000 kilograms. The remaining material would cost £3 per kilogram. Okay, so the plan is to make and sell 21,000 units each year. Now, the only problem here is that they can only do 20,000 kilograms and each unit requires 2 kilograms of material. So we definitely don't have enough at the lower price of £2 per kilogram. So there are going to be some charged at £3 per kilogram. So to calculate the material cost, we would therefore do the first 20,000 kilograms multiplied by £2 per kilogram. Now, if it takes 2 kilograms to produce 1 unit, that 20,000 kilograms is going to cover 10,000 units. However, if we're wanting to make 21,000 units, we've still got another 11,000 units to make, and that's going to be based on the higher price of £3 per kilogram. So once we've used this first 20,000 kilograms, priced at £2 per kilogram, which is obviously £40,000, we then need a further 22,000 kilograms, because 11,000 units remain, 2 kilograms per unit, and therefore 22,000 kilograms at £3 per kilogram. So it would be 22,000 times by 3, which gives you 66,000, plus the 40,000 for the first 20,000 kilograms would give you a total material cost of 106,000. Okay, then the next one is direct labour. So it states each unit takes 15 minutes to produce and production workers are paid £12 per hour. So if we're wanting to do 21,000 units, you could do this in multiple ways. You can obviously make 4 per hour because it's 15 minutes to produce 1, or you could do 15 minutes multiplied by 21,000 units and then divide it by 60 to get the amount of hours needed. Either way would work. It's entirely up to you. I'd probably do it that way. So I'd probably do 21,000 units multiplied by 15 minutes, which gives you 315,000 minutes, divided by 60, which means you need 5,250 hours. Multiply that by the £12 an hour, which means that the labour cost would be 63,000. So let's enter that in. The supervisor we said is not relevant, so that would therefore be 0. And then the factory rent would go up by 31,500. So we can enter that straight in. Giving you a total cost then of producing these in-house of £200,500. Fantastic. Again, hopefully fairly straightforward. So the last part then is part E, and this one looks to be on linear programming. So identify whether the following assumptions behind the use of linear programming are true or false for 5 marks. So again, 1 mark for each. So linear programming allows for multiple objectives. So hopefully this is something you've read about in your book. If not, it's definitely not going to be something that you can just guess. However, this should all be detailed within your textbooks. So linear programming allows for multiple objectives. That is incorrect. You can only have one objective function. So that would be false. The next one, each product always uses the same quantity of scarce resource per unit in linear programming. That is absolutely true. Obviously, you don't have the ability to vary the amount of resource per product when you're doing your calculations. Therefore, it is assumed that each product uses the same quantity of scarce resource. It is a useful tool, linear programming, but it does have its limitations. The next one, linear programming can only be used in situations where there is one scarce resource. That's absolutely false. The opposite of that is where we have more than one scarce resource. If you only had one scarce resource, you would simply use limiting factor analysis. Where you've got multiple, that's where linear programming comes in. So that would be false. The next one, the contribution per unit is constant in linear programming. So that would be absolutely true. Again, it's similar to what we said in part 2, or the second assumption. The contribution per unit can't change. Because this is a mathematical technique, it assumes a constant rate for both the scarce resource and the contribution per unit. So it can't change partway through, because the way the formulas work, or the way the graph would work, simply doesn't allow you to do that. So that would be true. And then lastly, linear programming ignores fixed costs. Again, that's absolutely true. Fixed costs obviously don't change. We're trying to determine the highest contribution per unit, given that there are multiple scarce resources. So we're looking basically for the best product mix to maximize contribution, and that completely ignores fixed costs. So that would be true. Fantastic. So that covers task 5. Let's now move on to task 6. So task 6 is worth 14 marks, and this task is about long-term decision making. This task contains parts A through to C. Part A, complete the following statement for 1 mark. The concept of the time value of money states that, and we've got 4 options. We've got money to be received in the future is worth less than money now and is more certain to be received. It's certainly not more certain to be received, so that top one's definitely not correct. Obviously, the further we go in the future, the less likely it is to be received. Which actually discounts the second one as well, because again, it's certainly not... The further in the future you are, obviously, the less likely it is to be received, not the more likely it is. So we can discount the top 2 straight away. So the third one, money to be received in the future is worth less than money now, which is true. It's if obviously going on the past with inflation, etc., we know that over time products or everything really costs more. So what your money is now will be worth less in the future. You only have to look at house prices to know that. So that would be the correct option. I'm just going to make sure the bottom one is false as well. So money to be received in the future is worth more than money now. Obviously that's incorrect. So it would be money to be received in the future is worth less than money now and is less certain to be received. Moving down then, so M Limited is deciding whether to launch a new product. The product would have a selling price of £70 per unit and a variable cost per unit of £20, and overheads would be £250,000 per year. Forecast sales then, so we've got year 1, 5,000 units, year 2, 8,000 units, year 3, 12,000 units, year 4, 10,000 units, and year 5, 7,000 units. The initial investment is expected to be £500,000. Part B then, calculate the non-discounted payback period in years, and we need to use a minus sign to indicate any cash outflows. Fantastic. Okay, so we've got an initial cash outflow of 500,000, which it states here. So the initial investment is expected to be 500,000. So let's start off by entering that in. Nice and straightforward to start off with. So your annual cash flow in year 0, so at the very start of the project, would be 500,000 going out. Obviously, with it being year 0 as well, the only cash flow we've had so far would be the minus 500,000. Okay, so moving on from there then. So let's have a look at these annual contributions then. So it states that we've got a selling price of £70 per unit and a variable cost of £20. So our contribution per unit is £50. If our selling price is 70 and variable cost is 20, we've got a contribution of 50. So all we need to do, bear in mind the overheads have already been recorded in this column here. So all we need to do is take our contribution of £50 and basically multiply it by each of the units in each year, and that will go in this column, this annual contribution column. Okay, so year 1 would be £50 multiplied by 5,000 units. So that would give you 250,000 as an annual contribution. Your annual cash flow will therefore be 0. We've got annual contribution of 250, we've got the overheads of 250, therefore your cumulative cash flow would remain as minus 500,000. We've had no changes within year 1. Now year 2, so this would therefore be 8,000 units multiplied by £50, which gives you an annual contribution figure of 400,000. Therefore your annual cash flow, bear in mind you've got a contribution of 400,000, and annual overheads of 250, meaning your annual cash flow for this year would be a positive 150,000. And that changes your cumulative cash flow now, because we can add on 150 to our minus 500, which means our cumulative cash flow would be minus 350,000. So then for year 3, we've got 12,000 units. So it'd be 12,000 units multiplied by our contribution of £50 per unit, giving you an annual contribution of 600,000. Meaning your annual cash flow will be 600,000 less 250,000, giving you 350,000. And that brings your cumulative cash flow down to 0. Okay, so your payback period is bang on, or exactly 3 years. So down here, we can see we've got payback occurs in, and that would be year 3. Fantastic. Okay, so that one was fairly straightforward because it worked out exactly year 3. Now, it is possible that you may have to calculate both the year and month in which it was paid back. Obviously, it's not in this example, but that is feasible that you may have to do that. Okay, so moving down to the last question on here. Oh, this looks a fun one. So M Limited are evaluating a long-term investment proposal. This is going to be your IRR calculation. So M Limited are evaluating a long-term investment proposal and have calculated the following. So we've got discount rate at 10% and 20%. So these are your lower and higher amounts. And a net present value at 10% of 569,000 and a net present value of 20% at 126,000. So what we're saying is that our internal rate of return, our IRR, is between 10% and 20%. And what we need to do is use this lovely formula here in order to calculate the exact percentage. Okay, so calculate the IRR of the proposed project to 2 decimal places. So all we need to do is put these figures into our formula. This is going to be fun to put on screen, but I shall do my best. So rate 1 is 10%, rate 2 is 20%, and then your net present value 1 is 569,000, and net present value 2 is minus 126,000. So with that in mind, what we need to do first is our brackets. So it would be 569,000 divided by 569,000, and then it's minus 126,000. So obviously that becomes a plus. So it would effectively be on this bottom row, 569,000 plus 126,000. So if we do that, we can put that in the calculator. We then multiply that figure by the difference between our rate 1 and rate 2, which would be 10%, because 20% minus 10% is 10. So we take this figure within our brackets, multiply it by 10, and that gives you a value of 8.187. So we just need to round that up to 2 decimal places. So it would be 8.19. And then we add that to our rate 1, which is 10%. So it would therefore be 8.19 plus 10, which gives you an exact internal rate of return of 18.19. That was fun. What a way to end the task. Okay, so that does finish off task 6. And that finishes off part 3 of this mock walkthrough. Within part 4, I'll be taking you through tasks 7 and 8. Thanks again for watching. I'll see you in part 4.